All right, I think we'll get started and it will make people come, hopefully. So thank you everybody for being here. I have the pleasure of welcoming Lance. Lance, you started your career a few decades ago in London, and then you started Markets at the time, merged it with IHS, created IHS Markit, and scaled it until a very big M&A transaction with S&P Global. So thank you for being here. And what I would like to achieve during this conversation is to talk first about the background behind the beginning story of markets, the importance of market data and financial services in financial markets at the time, how it evolved over time, and then focus on more how blockchain is changing the nature of markets and how it makes data increasingly critical. So that's what we're going to try to cover. But first of that, yeah, I would love to hear about the early days of market and why data was so critical.
Okay, great. Well, thank you for having me. And I know from being amongst many of your guests here that there's a lot of entrepreneurs and people creating companies generally to disrupt markets in the way that markets are managed today. And Market was something similar to that, except it focused around the derivative markets, which were also very opaque. Data was not easily available. Regulation was just beginning. We had the collapse of Enron. And so similar to many of the things that I'm hearing here, when you want to disrupt a marketplace, you're going up against very large players that actually like it just the way it is. And so when I think about exchanges, you know, you're going up against probably $1 trillion of market cap of big exchanges, or you're going up against many banks that you know, like to do things the way that they've always done it. Payment companies that are worth, you know, $500 billion to $1 trillion. There's several of them. And those are people that your products and services are looking to disrupt or change the way that we're doing things. And my only advice is where the opportunity exists, make them your partners. Otherwise, you're going to spend years fighting the current established market participants with large market cap that will look to block your progress because they like the way things are done. They've got a regular growing marketplace that serves them well, makes them, you know, a great return. And your disruption without them will cause a lot of pressure. And that includes all the information services providers that, you know, you might be up against as well. And I know you look to make partnerships with those providers. And I think that's the way forward. Where you don't have an obvious smooth sail, make some of the largest participants your partners.
And so do you think that what we're seeing right now in all of the institutions, we're seeing announced tokenization roadmaps, and like now we're having like, you know, board level discussion around digital asset and blockchain and tokenization at most of the financial institutions. Is that something that is newer, the fact that they're now really embracing this new technology? Or yeah, how real is all of this?
Well, I think like all new entrepreneurs, people starting businesses, there's a lot of hype created. And so at first, the hype creates interest. And then as that hype turns into revenue and even profitability, it actually starts to, people start to take notice. The thing that I find really interesting is, well, I like to look at power alleys when I invest. Power alleys, crypto's a power alley, AI's a power alley. I'm involved in energy transition, it's another power alley. And when you get inside a marketplace where you can really enact change, initially people understand, you know, I love the idea that I could process a loan or, you know, a natural gas contract, you know, instantaneous. Sounds like it can take a lot of problems away, free up capital, make things more efficient, and therefore will tend to more profitability. So everybody likes that, of course. But when you approach it and you start to get involved and you're J.P. Morgan or Deutsche Bank or any of the other big banks around the world, obviously operational excellence is really important. They can't afford to make mistakes because with their size of a balance sheet and their profitability, the risk of from a legal perspective is very high. Compliance, their regulators. Yeah. So they have to be very careful. But you can see that the momentum's building in your favor, yeah. And there's many market participants that are testing and starting to build applications and think about disrupting themselves, yeah. Which is quite good.
And I think it's drawing back to the kind of early days of market and where we, and specifically we, Kaiko, are in the blockchain, capital markets, moving on-chain world. You at the time really focused on kind of critical data, critical market data to enable financial applications, operations, and all sorts of actual financial contracts, not so much on a more typical data play that would involve more dashboards and terminals and media. And I think your focus on critical market data to enable application is really something that was an inspiration to us when we scaled Kaiko, and that takes all of it meaning now as we're moving into the world of financial contracts being executed on-chain. That requires that same kind of critical data input to feed into contracts to enable execution. But that was a bold decision 20 years ago when you started Market, which was to say, I'm going to just focus on critical market data. And can you talk a bit about that and then how you see that as a continuity now that we're seeing novel infrastructure?
No, I like that, and I think it's the same today, because when I look at, when I think back to that time, 2003, Enron collapsed and nobody had any of the data, the main data sources were exchanges, brokers, and then the banks that were obviously providing the mark-to-market on the positions that were trading. And historically, if you traded with Goldman Sachs, you accepted the mark. That was the data that you got. And when I first met people from, at that time it was Reuters, it was Thomson, it was Bloomberg, they didn't like it, but I viewed them as television sets. And I used to say, well, if you're Samsung or Sony, you're nothing without content. And if you look today, an iPhone's nothing without apps. And so I took this view that content actually was the thing that made people look at something. And if you could have deep and rich enough content, you could do a lot more with it than just allow for an execution of a trade. You could do research, you could do mark-to-market, valuations, forward projections, back testing. So all the operational aspects around a trading room, which I was head of a global credit portfolio, I found that why not take a surgeon, somebody that actually knew the markets, and then say, well, let's do the bedpans and the operational excellence around the surgery, because if you really understood the patient on the bed, you actually are going to be able to do a much better job. And so by moving into this area of data and content creation, by partnering with the surgeons, which were still left at all the banks, we were able to convince that if we created complete data sets around the credit markets, we could in fact increase volume substantively. And then, of course, we created indices, iBox, CDX, iTraxx, a whole bunch of indices. And by creating those, we brought even more liquidity to the marketplaces. And from there, you had to process, you had to value. And so we just kind of moved up and down that food chain. But the key message would be find the market participants that you can be close to, that are going to allow you to build content that are as better than what's available from any individual party. So JP Morgan might have been 40% of the credit markets, but by the time I got 15 other financial market participants to partner with me, actually the richness of my data set was much more than they had. and so they were forced to come to the marketplace. And I think that's the same for the world that you're operating in. You have to find those partners and make sure that you get the best content available.
Yeah, I love what you said. Market infrastructure without data is like a phone without apps. I think I'm going to keep this one in my marketing. You brought up Enron and a couple of other kind of inflection points in the market a few times. Do you think that regulation is critical to the advancement of innovative solutions and thinking differently and kind of shaking up the establishment of institutions?
Well, I think actually regulation can be a substantive tailwind for some market participants. You know, of course, if, you know, you're digging coal and the world says there's no more coal and Charles Dickens is out, that's regulation that, you know, hurts. When you saw it the same with nuclear, you know, in Europe. Now, we may go back, but at the time, if you were a services provider or partner or planning agent or doing anything around those marketplaces, you saw your business collapse. For me, when I look at the regulation that will approach the markets you're in, I would see for many of the players in the marketplace that look at regulation as an advantage, they're going to get a growth spurt that's quite substantive. And for me, 2008, when the market had the big crisis in 2008, we were probably about 1,000 employees, a few hundred million of revenue, and we went into a hiring freeze. We started to panic about our growth, and that year we grew more than any other year, and we actually were short-staffed. We were scrambling, infrastructure was breaking, operations weren't, you know, what they needed to be. And so no, I think regulation can be a substantive tailwind to market players that embrace it the right way and participate, you know, in the slipstream of regulation.
Absolutely. And so for context, the reason I'm asking this is in crypto is largely unregulated, still is. Obviously now you have regulated crypto financial products, but originally it was a very unregulated market, and one where there was the perception that market data was freely available and thereby kind of had no value. And it's only now that we are we're not just looking at crypto assets as an investable asset class, but we're moving into leveraging blockchain technology as an underlying infrastructure for executing traditional financial contracts, and whether that's repo, whether that's collateral mobility, margining, and all sorts of just pure TradFi applications that are just executed on a blockchain because of the nature of the decentralized golden source of truth database layered with smart contract. That means that the prerequisites for data that was already there in crypto is really not kind of suited to be upgraded into the capital market stack, just because it's a very different relationship with market data. I feel that crypto was very retail and you know, averaging data was appropriate. In capital markets, now that we're using the blockchain just as an infrastructure and then creating smart contracts that are replicating traditional financial contracts, you need to have the exact data point that you want at that point in time provided by someone who you can trust. And I think that's a big shift where we're seeing that the technology, the blockchain technology works, smart contract logic works, tokenized assets are coming, regulated stablecoins, cash equivalent, tokenized treasuries, all of that is coming to the blockchain. And in my opinion, one of the big missing critical pieces of market infrastructure is that real-time data infrastructure to feed all those traditional financial contracts with traditional market data. And that's really, when I draw the parallel on market and what we're trying to do, it was really this critical market data angle feeding into contracts, enabling trading and execution.
Right. So I don't know how technical everybody is on derivatives, but I think there's some really good comparisons. So, you know, if you take, you know, the brokers in the derivative markets, you know, at the money, short-dated contracts, all the data in the world, and you can have it for free. Okay? 2 years, 3 years, 5 years, 10 years. People were doing 100-year, currency swaps on huge infrastructure projects. So, all of a sudden, the data disappears. And like in many of the new products, like today I met somebody in the audience from a company said they're doing options on 400 different coins. And I went, okay, that's a data problem. Once you execute that, how am I getting the good data? So what happened in the derivatives market, which I think would provide some parallels to your marketplaces, was we created this service. It was called Totem. And what we did there is we built the volatility surface. So all the out-of-the-money strikes and term as long as possible. And then participants started to get into that model. And the participants had to have a position that they were marking to market to participate. And if they did, they got the data back as long as there was 3 points, and the 3 points were statistically significant. And that became very interesting because if you couldn't provide a price that was within the context of the market, you were rejected and you got no data. So then your firm knew that you weren't pricing in the context of the group that were pricing. Now, you might have been right and the market was going to move your way, or completely wrong and take the loss later. But what was interesting is all the asset managers in the world, so these are all the people that wanted to participate in these marketplaces, needed the data both pre-trade and post-trade. So by providing them an organized vol surface that they could look at, and it was only once a month, but there was no derivative contract in the world and no point on a vol surface that wasn't covered. And that data set allowed asset managers to participate like they'd never done before. And of course, that became our growth for customers, thousands of asset managers, hundreds of second-tier banks that didn't market make, that had positions for hedging, and then of course the big players that actually made the prices expanded their marketplace. I think those comparisons across digital assets are really important. Find the market participants that are creating positions and study where they are marking and valuing their assets to create the data sets that need to be put together for a full picture of the market that you're in. The brokers, they'll try to put curves and extend model data prices, and they'll do not a bad job, but that's never good enough. And a lot of times it's self-serving.
Yeah. I love that you're a data purist, because very often we've been running a data company for 11 years. In crypto, we have all sorts of high quality, real-time, tick-by-tick data for everything trading everywhere in the world. And I get a lot of, why don't you start a fund? Why don't you start trading? Why don't you also route orders? And why don't you do execution? And all these things. And I've stayed clear of everything that was not just market data and data feeds. Obviously, we went into analytics and indices, but remaining as a pure player in the world of data and information services is something that I think I maybe do because I tried to follow a little bit the story of market. Why did you, at the time, decided to stay super focused on data and not branch out into all sorts of things you could have done with the data you had?
Well, I think at some point you get if you have enough growth, and when your company's being valued, of course, organic growth, gross margin, EBITDA, earnings, and earnings per share if you're public, that's the stack, and many of you are aware of that. I never had a company that traded at 40 times revenue, sadly. I met one this morning. I thought that was interesting. But if you're being valued, those are metrics we all know long-term create value. As your revenue starts to arc and you become, a much, more, a must-have, good data source, you've got a little bit of price regularly in your organic growth, but the TAM for the marketplace, isn't, continuing to grow. Then you becomes saturated and you need to look for ways to go, up or down that stack to, add value. I think the common places, if you have the best data, where can you use it? So pre-trade. Think about all the things before somebody makes a decision. How is your data going to help them make a better decision? Secondly, post-trade. They've made a decision. They need a value, and they need to understand, the quality of, the position that they have. And finally, building around the data other things like research, market commentary, but don't compete with the people that need the data. If you become an asset manager, you become a custodian, you become a broker, you become an exchange.
Yeah.
I looked at all of those, and it was very enticing to combine with TradeWeb or Market Access or, acquire, a broker. That's the no-no.
Yeah.
As soon as you cross that line, I think you're finished.
Yep. Well, I love the pure data play. Thank you very much, Lance. Thanks, everyone.
Thank you. Thanks for being here.